And welcome to another Lumi Financial Corner. With us once again, Michael Zaremsky, head of U.S. Private Banking, Bank Lumi USA, member of the Investments Committee for Lumi Investment Services. Michael, good to have you back.
Good to be back, Zev. Thank you very much.
And thank you. I'm curious, Michael, we've seen what's happening in Afghanistan, the budget talks in Washington. How much do these factors that I just mentioned and others affect the markets? Do they or don't they?
Zev, it's a great question, and I think current events are important to what's happening in markets. But before I do answer that, I'd like to state that the views represented on the call are my views, not necessarily those of the bank or the broker-dealer. I think we could all agree that there's a lot of tragic events happening in Afghanistan right now, and the pictures that we've seen recently have been very disheartening. However, given the economic state of Afghanistan and given that part of the region, really not a very big impact on the capital markets, although I do think that there could be some trickle effects in terms of confidence, market volatility, or just a fear factor. But ultimately, at this point in time, I think it's something that bears watching, but I don't think that there's any real direct threat from the events in Afghanistan into U.S. capital markets. I will say that the budget conversations in Washington definitely bear a whole lot more watching. As many people will know, there was a deal cut where there was a bipartisan agreement between Republicans and Democrats that put together an infrastructure package. That was a very attractive deal for a lot of people, polls very favorably amongst Americans. And there's a lot of discussion about how the bills will pass through the House because they're also looking to do a $3.5 trillion reconciliation deal for the budget. And how that happens, when it happens, and how it gets pushed through will be interesting to watch. At this point in time, it seems like there's a lot more affinity for the infrastructure bill in polling than there is for the $3.5 trillion spending bill. And it'll be an interesting act of negotiation and navigation to see how that passes. So at this point in time, I think that they are big headline issues that definitely bear watching. But again, I don't think that there's a whole lot of impact right now. I think more eyes are on the Fed, and I think the other elements out there in terms of valuation and other concerns about what's happening in the markets themselves.
So what are some of the other factors that we should consider looking at how the market's going to perform?
Well, what I think is interesting to always wonder is where is consensus wrong, or really trying to determine what's priced in the market versus where you may have a differing opinion. And one of the things that I think has been occurring throughout most of the last few quarters is I think the market in general has underappreciated the strength of the economy. And there's two elements that I think have been most interesting to watch over the last 3 months or so. Number one is corporate earnings. And typically corporate earnings as reported will beat consensus estimates by about 5%. Over the last 40 quarters, so the last 10 years pre-pandemic, the corporate earnings announced on a quarterly basis by the S&P 500 beat expectations by 5%, and that's a pretty standard number. Interestingly, in the last 5 quarters post-pandemic, corporate earnings beat expectations by about 20%. So that's a huge disconnect. So when people say, what is the market getting wrong or what is consensus getting wrong, I think got wrong consistently is the strength of corporate earnings. Corporate earnings have continued to outperform by a massive amount relative to expectations. The other thing that I think the market's not really quite getting right is they're not focusing enough on productivity growth. And you and I have had many conversations about, how our economy is headed into the information age and how productivity gains occur from that, and how one of the big headwinds against inflation is productivity. I think some of the statistics are actually amazing on productivity gains that we've seen recently. GDP is now at an all-time high in the United States. It's gotten to levels above where we were pre-pandemic. We've done so with about 6 million less workers and about 3.5% fewer hours worked per week. So we've basically eclipsed all-time high GDP levels with less people working and people working overall less hours. Ultimately, what that translates into is just about a 4% productivity rate for the 5 post-pandemic quarters, which is a rate that's far above trendline pre-pandemic. So there's been some major changes and major shifts in the economy, and I think that those are here for the long haul, and I think that that's two places where the market's really gotten it wrong. and where I think that there's opportunity to kind of bet against consensus, if you will. And one of the things that I think is important when you move on from corporate earnings and the productivity growth is what that impact has on valuations. If you're looking at the market in more of the old stagnant way, the market has definitely seemed a little bit expensive. But if you think about how badly consensus missed on things like earnings or things like productivity, we can look at it in a different light. At the end of Q1, the PE ratio for the S&P 500 was 22 times earnings, which again is a level that's deemed to be relatively expensive. If you factor in the amount of growth that we actually saw in corporate earnings, and then you look back and say, what would the PE have been if we were accurately predicting what the earnings were? The PE ratio drops down to 19 times earnings. Still a little bit high, but nowhere near kind of that loftier level of 22 times. So I think that the market's really gotten it wrong on recognizing where corporate earnings are, where productivity growth has been and will probably continue to be in the economy, and what the overall impact of that is on valuations. So when the bear case argument against stocks is that things are really expensive, I do think that there's a little bit of a miss out there in not understanding why things are not really quite as expensive as people think they are.
Michael Zaremsky, head of U.S. Private Banking, Bank Leumi USA, member of the Investment Committee for Leumi Investment Services. Thank you for sharing your insights as to what makes the market tick. So look forward to our next conversation.
Thank you very much, Zev. I appreciate it, and have a great day.
And we're going to be right back. Don't go away. Stay tuned.